Hi everyone. I am so honored today and happy that Eric from CMA Loans joining us today to teach this special class, because even as a realtor, as a real estate agent, I was even confused. What is second home? How many miles? And recently I went to a realtor program, right, where they teach only professionals. And I was surprised how much new information I learned. And I was surprised how many agents didn't know even what the little I knew already about segregation, 1031 exchange, and all this multifamily. What's the difference? Commercial, multifamily.
Yeah.
So I learned so much. So
Awesome.
thank you for joining. It's really my honor. So first I'm gonna introduce myself too, and then you're gonna tell us all these details about loans,
Absolutely.
right? So
Yeah.
a little bit about myself. Many of you know already. So I'm a managing broker, which is not only agent, but I can have my company or my team. So it's a next step, right? And if you look up me on the Zillow, YouTube, Instagram, you will see hundreds sold houses and a lot of 5 stars review, almost 100 5 stars reviews. And I was doing property manager for 2 years, and I'm still helping my buyers to rent out the investment properties. So many of you knows why do you want to buy a home, right? And I always say, for anybody who makes more than 100,000 a year, you do it for tax purposes. So you want to go in a different tax bracket, if anything else. Actually, I want to spend like 3-5 minutes to talk about new rules. Because actually these rules came already to us 3 years ago. And all this form on Northwest MLS already exists, with form 41, 41C, when we ask actually a seller or buyer to pay us commissions. So it's already inactive for like 2.5-3 years. So there's nothing new. The new is only this case, which legal case was on East Coast, finally is finished, right? But all these decisions, all these new documents we already been using. And if you remember during COVID times, when it was like very strict sellers market, very aggressive, I saw even in Kirkland for houses for like 1.5 million, seller would write, I pay $2,000 commissions for buyer's agent. So not 2%, not 3%. So on Northwest MLS, our buyers and sellers always have the right to choose how many percent or how much money they want to pay to the agent. So I don't understand why everybody is talking about this right now, because it's been already in place and we were doing these documents and everybody read these documents already hundreds times, and it's always been negotiable. The thing is, on East Coast, only maybe 60% agents members of MLS. In California and Washington State, 100%, it's monopoly. MLS is monopoly, you know. So each of us, we are members of MLS. I cannot list any house without MLS. I'm gonna get 3,000 penalty fee right away if I advertise any house without being on MLS. So basically we follow these rules very strictly for years now. This is showing our market. Basically what I want to show, for last 40 years, our prices every year increased 8% grossly. So it's pretty much safe to buy in Pacific Northwest region, in Greater Seattle area, because all the houses costed in 70, $30,000. Now it's cost $2 million. So you just need to enter the market. Doesn't matter as a home buyer or as an investor. If you love living in Kirkland, Bellevue, with maybe water view, and you cannot afford a loan for $2 million to have a like luxurious maybe apartment with water view you have right now, but you do want to invest, you want to start somewhere to invest, you can buy investment duplex, fourplex, or a single house somewhere far away, maybe Lake Stevens, maybe Lake Taps, maybe Bonnie Lake, and at least invest there and grow your equity. So you're gonna live in your nice neighborhood where you love to live, walk to Kirkland downtown, and at the same time you're gonna accumulate equity somewhere in a house. So I think you have to start as an investor or to buy a house for yourself. It's all good ways. A little bit I want to say about success story of my clients. Many of my clients doing 1031 exchange, and you're gonna tell later, right, about 1031 exchange. This is how I show that people just have to enter market somewhere. For example, these people, they have only 5% down payment. So they put 5% for 700 house. So with 35K investment, 5 years later, they got 500,000 equity. Took this equity and bought 2.2 house in Kirkland. How else would you buy 2.2 house in Kirkland, right? Unless your company goes public or your Amazon stocks, I don't know, your Tesla stocks cashing out. So you invest 35 houses, plus you didn't pay rent, right, all this time. You accumulate all your equity, and when you finally buy a house in Kirkland, perfect investment. So why I recommend people do 1031 exchange? I recently have transaction, and actually the CPA tell them not to do 1031 exchange because they, as a husband and wife, they can write off 500,000. But I said, but you're not gonna have 500,000. You're gonna have 650. You know, how you gonna write off this? And he says, no. Our tax person says don't do 1031 exchange. We will write off 500. I said, okay, but still 150. What you gonna do? And they're like, we're gonna pay taxes. I'm like, how much? 30K. I'm like, why would you pay 30K taxes when you can pay 3K to facilitator and don't pay any taxes? So that's why we invite today Eric, and to educate people how to invest smart, what can you do, what kind of programs you can use mortgage wise, and how to start investing in real estate and grow your portfolio and retired in 10 years.
Well, good. Well, thank you. Yeah, so I'm Eric Aasness, and with CMG Home Loans. I have been in the mortgage lending industry for over 35 years. So I've been through lots and lots of cycles. I consistently rank in the top 1% of loan officers nationwide. So we do a lot of business. And I work with first-time home buyers. I work with investors. I do renovation financing and construction financing. So pretty much all different types of home loans, everything that's a 1 to 4 family property. So hopefully, yeah, my background, experience, and war stories will help you with your journey. So I thought I'd talk a little bit first about some first-time buyer things or owner-occupied type transactions, because that's how you start, as Anna was mentioning, when you create wealth by buying real estate. And you buy a $700,000 home, you put $35,000 down, you're investing $35,000, but you're getting equity on $700,000. It's huge. You get all that wealth building. And so we like to say, that's how you start out. Build some equity, then take that and move on to the next one, or keep that as a rental and buy another home. So we'll talk about that. First off, we'll talk a little bit about mortgage rates, because it's all over the news. And mortgage rates are, we had a low point during COVID. They got down in the 2.5% and 3% range. That ship has sailed. We're not going back to those rates unless something catastrophic happens in the economy. Interest rates will follow inflation. Inflation will follow the economy. As inflation falls and the economy slows, interest rates will drop a bit. But all of the financial experts think that this year, 2024, will probably end up somewhere in the low 6% range, probably not much lower than that. But that said, that's actually lower than about a 30-year average, which is 7%. And we're just a little bit under that right now. So rates are going to stay somewhere where they're at. We're not going to see them go higher at this point. They're not going to go back down to the 3% range. That's just not going to happen. So let's talk about some loan limits when you're buying a property in Washington State. If you're buying in King, Pierce, Snohomish counties, if it's a single family home, we have what are called conventional conforming loan amounts. They go up to $977,500 for a single family home, and then much higher for 2-unit, 3-unit, and 4-unit properties. And if you're buying in other counties, Kitsap, Thurston, Whatcom County, different parts of the state, then there's a loan limit of $766,550. If you're borrowing more than those loan limits, the loan becomes what's called a jumbo loan, and the rules are different. The down payment requirements are higher, and the programs and interest rates and things like that can vary as well. Should you wait to buy? You know, a lot of people probably ask Anna. They ask me all the time. You know, I'm going to wait for these high rates to crash the housing market, and then I'll buy. Not going to happen. Home prices in Washington State, especially in Western Washington, are rising. We expect that to continue. We are forecasting somewhere around 5 to 6% appreciation this year. And that's in spite of the interest rates. But the main reason is because we have a shortage of inventory. We have more people that want to buy homes than people that want to sell homes, or builders that want to build homes. And that trend is long term. It's going to stay like that, you know, probably forever in this area. So the demand for homes is greater than the supply. As a consequence, prices will keep rising. So waiting will just have you lose out on gaining equity.
I actually agree with you about the equity and about what prices are going to go up, because at least I have 10-15 buyers who have at least $500,000 cash ready to jump when something good shows up. Doesn't matter if land for $2 million gonna show up and where they can build, like buy land for $2 million, buy and then build a $4.5 million house. We are ready to buy cash with land. Almost everybody I know have at least $500,000 in stocks or cash ready, and we just, Anna, show us good deal, we're gonna buy. So we are ready. I don't understand when people say market gonna crash. How market gonna crash is always people sitting on a bunch of cash and waiting every day for something good to jump on it.
It's not going to crash.
So I don't understand how it's gonna crash.
Because people are thinking about 2008, 2009, where the market did crash. It went down 30, 35%. We're way back above that now, but there's it's a lot different now. Back then, number one, there was 18 months of inventory, way more inventory than we have now, and there was a lot of speculation in real estate at the time. And to be quite honest, as lenders, we were making lousy loans.
It's true.
Anybody could get a loan, zero down, didn't have to prove income or anything.
People didn't have skin in the game.
No.
So you can buy like $500,000 house with zero down, with great loan, interest only loan, not pay anything for 3 years, and then bankrupted. And people won't go in bankruptcy because you have nothing to lose. You put down. Right now, everybody sitting, you saw, on an equity. If I have like 350 equity in my house, how are I gonna file bankruptcy? I want my at least 350 back, you know. But if I got loan, zero down payment, interest only, of course I don't care to bankrupt this house.
It was easy to walk away.
This is what it was in 2008, and it's not right now. Right now, everybody putting big down payments. They have something to lose, so we're not gonna bankrupt the houses.
Absolutely.
So that was my 3 cents.
So don't wait. No, absolutely. All right, so let's talk about some loan programs, and these are for owner occupied. So if it's your first home or not your first home. First off, the minimum down payment, if you are a first-time home buyer, you can buy a home with just 3% down if it's a single-family home. If you're not a first-time home buyer, it's going to be 5% down. And if it's a 2 to 4 unit property, duplex, triplex, fourplex, this is a recent change, 5% down. In fact, I have a client that just bought a duplex with 5% down. He lives in one side, he's renting out the other side. The rent on that other side pays about 3/4 of his mortgage payment. I have another client that's a veteran, and he just bought a fourplex owner occupied for $1.6 million. He's living in one unit, and the other 3 units are making his mortgage payment essentially. So there's, and that was a zero down transaction as a veteran with a VA loan. When you put less than 20% down, a loan will require PMI, mortgage insurance. You get nothing for PMI. All it does is if you ever were to default on the loan, it pays the lender's loss if there is a loss. The cost of PMI, though, goes down the more you make as a down payment. So at 3% down, it's at its highest level, most expensive. It's lower at 5%, 10%, 15%, and then if you put 20% down, there's no PMI. So I have a graph that sort of illustrates differences in the cost of PMI with low down payment, higher down payment, higher, and 20% down. So you can see what that looks like. This is for an $800,000 home. And you can see the difference in the cost and also in the cash that you would need to close on a typical transaction. So PMI on a conventional loan does not need to stay on the loan forever. You can get rid of it without even refinancing. There's a few different ways to get rid of it. One is that once you've paid your loan down to 80% of the sale price, you can get rid of it. The other is after 2 years, we can do a new appraisal, and if your loan is no more than 75% of the loan balance, we can get rid of it. A third way is if you remodel, and we can do a new appraisal, and as long as your loan is no more than 75% of the new appraisal, we can get rid of it, and there's no time limit, no waiting period on that. Or we could refinance, and as long as the loan is no more than 80% of the new appraisal on a refinance, we can get rid of it. So PMI doesn't need to stay on there forever, but it helps get into the home sooner, much more quickly. You can start building equity sooner, much more rapidly.
So Eric, I heard with great, in our state, we have great programs with even zero down, not even 3.5% down, but even zero. And a lot of people come from different countries. They don't have anything to put down payment. Plus, you still need extra money for closing costs, right?
Yes.
So I want you to tell about these amazing programs in our Washington state with zero down payment options.
Sure. All right. Talk a little bit about zero down options. So you do not need to be a first-time home buyer to buy a home with zero down. There are programs in Washington state where as long as you have income no higher than $180,000, you can buy a home, single-family home with zero down, or a duplex with zero down. And the programs are, the most popular one is one called Home Advantage. And what it is, it's a combination of two loans. We have a first mortgage for 97% of the sales price, combined with a second mortgage for up to 5% of the first mortgage loan amount. That makes up your down payment. The second mortgage has an interest rate of 0, and there's no monthly payments required on it. It just sort of sits there until at some point in the future, you either refinance, sell the home, or at the end of 30 years, at that point, that loan would be paid off. So that's called Home Advantage. A second program is called Home Opportunity. And if you're in a low to moderate income level, it's going to be roughly about $80,750. So if your income is there or lower, it's also a zero down program, but the interest rate is significantly lower. And there's also some programs which are FHA loans. We have one called Chenoa. We have another one called Buyer's Choice. And what these are, an FHA loan with 3.5% down, combined with a second mortgage for 3.5% down at 0% interest rate with no monthly payments required. And on that program, if you keep that house for 5 years, that second mortgage is fully forgiven. You never have to pay it back. So quite a few different options for first-time buyers. There's other ones as well, but these are probably the most popular out there.
So Eric, I wanted to ask you, what's the difference if you have already primary residence, right? You want to buy one more, maybe you have enough money to put for down payment. So should you do it as an investment property or second home? Because I think mortgage rate gonna be different, right?
Well,
so what's the difference? Second home or it's already investment?
That's a great question. The rate, there used to be a difference in rate between a second home and an investment property, but in the last year, the government lending agencies, Fannie Mae and Freddie Mac, changed their rules. And it's the same rate as investment property. Yeah. So you can buy a second home with 10% down, and whereas an investment property is going to be 15 or 20% or more. Right. And that's really the main difference anymore. We call a second home anything where you live in it at least 14 days out of the year, and that's how the IRS looks at it as well.
14 days, 2 weeks. So 2 weeks you use it as a vacation. The rest of the year you can rent it out. So you don't need to save 20%. You put only 10% down.
Correct. That's right.
I remember it from before, like it has to be within some mileage.
Yeah, they used to have a
rules.
requirement that a second home had to be at least about 50 miles away from your principal
50,
residence,
50,
50,
50 miles.
and
Okay.
that it be in typically a second home or resort type area,
Yeah.
like around here it might
Dacha.
be Lake Chelan or Leavenworth or something like that. We don't have those rules anymore.
I didn't
So
know.
a
You see
second
always
home
something
could
new.
be
Nice.
in the neighborhood if you wanted.
Same rate, less
same rate.
down, and it doesn't need to be 50 miles away anymore.
Correct. That's
Good,
right.
good rules. Same as with amazing rules about from November 18 about fourplex.
Yes.
Where you can put 5% down.
Absolutely.
You talked recently.
Yep.
Okay, thank you. Something new. You learn something new every day.
Yep. So let me talk real briefly also about non-owner occupied or investment properties. And I could talk about this all day long, but when you're buying an investment property, a non-owner occupied property, there's some really cool features there. And there's a couple things that are different compared to owner occupied. First is the down payment. The down payment's higher. For a non-owner occupied property, you have to put at least 15% down for a single family home. But then it's going to be more. It's going to be 25% down if it's a 2, 3, or 4 unit property. So higher down payment requirement, for all non-owner occupied. There's some additional rules as well. In addition to the higher down payment, you will pay a higher interest rate, because it's non-owner occupied. It's roughly about 0.5% to 0.6% higher interest rate. We can finance up to 10 properties using standard loan programs. So we look at all of the properties you own that have mortgages on them, all 1 to 4 family properties. You can have up to 10 using standard loan programs. So plenty of room, get busy.
So 40 units, you can buy 40 units with a loan.
10, you could, yeah. I mean, if you count the doors, if you bought 10 fourplexes, yeah.
10 40 doors.
Including your primary residence.
So that 39 doors.
Exactly. If you're trying to get the seller to pay your closing costs, that's okay, but they can only pay up to 2% of the sale price towards your closing costs. Owner occupied, they can pay more than that. When we do an appraisal, the appraisal will also look at rent comparables. So the appraiser will look at what's the fair market rent for this property as part of their analysis. And that's important because we can use the rent that the property generates to help you qualify. And I'll talk about that next. This is the formula. So when we qualify you for a rental property, we'll take the fair market rent minus 25% minus your mortgage payment, principal and interest, taxes, and insurance. If the difference is positive, we add it to your income. If it's negative, we would treat that like a debt, like a car loan or a credit card payment. So when you're buying a rental property, you do not have to qualify for the whole mortgage payment. You qualify for the mortgage payment minus 25% of the rent, which makes it really easy to qualify for rental properties as long as you can cough up, a higher down payment. So that's the catch. We also have a program which is called Investor Cash Flow Program. And this one's designed for people who maybe their tax returns don't support buying an expensive home. Maybe they're recently self-employed, or maybe there's something with their income situation that just doesn't work for a traditional loan. We use an investor cash flow program, and the way this program works is your mortgage payment can be no higher than the rent the property generates. So if the property generates $3,000 a month rent, your maximum mortgage payment would be $3,000. This program requires typically a minimum of 20% down, but the amount of the down payment can vary depending on how much rent the property generates. And on this program, we look only at the income from the property. We don't look at your employment income, debts, anything else, just the cash flow on that property. So this is an option that can really be a game changer for somebody that doesn't quite perfectly fit into our standard mortgage underwriting box, our underwriting
self-employed people, right?
Recently self-employed, things like that.
Yeah.
Yes, that's right. So this is a really unique program. I talk a little bit about this in my investor classes, and this is net operating income. And this is just a really good tool if you're looking at buying a rental property to really analyze the net operating income for the property. And what we do is we take and I should add that when an appraisal is made on a rental property, the appraiser does this analysis for you. But I like to look at it for.
So this is pro forma. How say
yes,
pro forma, right?
Exactly. Operating income. Yep.
So and this is not the real one. This is based on comparison, right?
Well, this one we'd actually, I would recommend you actually run it for a property if you're interested in buying one, that you actually do this type of analysis. Okay. So we look at what's the annual rent minus expenses, property taxes, insurance, water, sewer, garbage, maintenance. Maybe you have property management fees. And we also look at what's called replacement reserves. Set up a budget. How old is the hot water heater? How much will it cost to replace it? How many years of life is left in it? How much should I budget each year so that into a savings account so that when it does finally blow up that I've got enough money saved, to replace it. Same thing for your appliances, for your roof, carpet, things like that. So you're just budgeting for items that you will need to replace eventually, especially with a rental property, so that you're not having to use a credit card or dip into your savings or something to, replace those items when they need to be replaced. So just a really good exercise, to do as we're going through things.
I want to ask you, everybody asking, what is cap rate? What is cap rate? And I know so many investors, they don't like this even word cap rate, right? They look at this formula, which you just explained, net operating income, right? Not a cap rate, because cap rate, you even don't calculate your mortgage payment into it, right?
No, you don't.
So, but so many people obsessed with what's the cap rate, right? Well, depends what's your down payment, what's,
Yeah, I bet that probably 95% of the real estate agents out there, even if they list a rental property, they'll list a cap rate. And if you ask them, how did you get that cap rate? They won't know. They won't know. So a cap rate really is just, it's that formula. It's a net operating income. So you do this analysis divided by the sale price. So it's a way of telling as a percentage kind of what sort of rate of return am I getting based on sort of the net operating income from that property. And everybody wants, with the cap rate, the higher the cap rate, the better.
The better, yeah. If you have 9, you're buying, right.
Right, but in this area, in the Northwest, you're not going to get it,
If you have 6.5 cap rate, but depends, if you buy all cash, it's one cap rate. If you're going to put only 5% down, it's going to be different cap rate. So how can you just say subjectively this cap rate? But if you get 6.5, you're already good, because you're going to increase your rent every year. You're going to increase your rent a little bit. So hopefully, maybe in 3 years, you're going to have 9% cap rate.
Yes. And knowing how to calculate net operating income, you can use that as a formula to also decide how much should I pay for this property to get whatever cap rate I want. So once I know my net operating income, my NOI, I divide that by my desired cap rate, and that will tell me what sale price I should pay for the home.
Yeah, exactly.
So you can work it backwards.
Work backwards. That's what I like. When I see, okay, cap rate only 4%. When this fourplex shouldn't cost 1.2, when we can buy it for 880. So this is, we do it backwards. Yes, okay, only 4%, when we're not going to pay you 1.2, let's go backwards and decrease the price.
That's right. And maybe they'll go down that much, maybe they won't, but
maybe I always try, just respectfully, and that's why I always say you have to play nice in the sandbox. Respectfully call our agent and say, we don't want to offend nobody, but this is how we willing to pay, how much, if it works, okay. If not, you can always counter us, but let's open door to negotiation. It's not like we're gonna be upset or something, but you just approach them respectfully, and maybe you're gonna meet middle ground, right?
For sure. Yeah, for sure.
So, Eric, I wanted to ask you about 1031 exchange. I know 1031 exchange is 6 hours class, right? But maybe just a little bit so people know and keep it on the back of their mind. Don't forget to do it. Don't forget to do cost segregation. It's great tools to save money on taxes. Eventually, you never pay taxes until you die. and then you and your kids can inherit it, but I guess they can inherit tax-free 6 million or how many millions? I forgot.
Oh, it's for a yeah, it's
Uh,
something like that. I think I
something
want to
like
say it's
that.
a little bit more than
A little
that.
bit more than that. I
Yeah,
forgot, maybe 9
12. It might be
million.
12 for
So
married.
basically, you never pay taxes, and when you leave it in a will for your kids, and your kids don't pay taxes too.
Mhm.
So this is how rich people never pay taxes, right?
It's
When
true.
you hear like Donald Trump or somebody never pay taxes, this is how they don't pay taxes.
Right.
They
Well,
always do cost segregation, 1031 exchange, boom, boom, boom,
we
boom.
just follow the rules. Yeah.
But we follow
You
the
got to know
rules.
the rules.
But
Yeah.
it's great tools.
Yeah.
And even some CPAs, some tax people, they don't know that.
Mhm.
You know, we talk about
Right.
this last time when we have Russian class. Like we have to convince our tax person 3 years
Yeah.
to please do this. And
Yeah.
in my recent transaction for 20 days, I was trying to convince the sellers, buyers to do 1031 exchange.
Yeah.
Somehow, some tax people, accountant, they even don't know about this program. So please tell us about 1031
Sure.
exchange a little bit.
Yeah, absolutely. It's called a like kind exchange, and what it means is if you own an investment property, has to be an investment property, not your principal residence, and you want to sell it. If you buy another investment property, you use the 1031 to avoid paying capital gains taxes on the property that you've sold. And the way it works is there's some timing requirements. And number one, so the timing requirements are that you have 45 days from the date your transaction closes to identify up to 3 properties. And then you have a total of 180 days, 6 months from the date you sold to purchase one of those 3 or any combination of those 3. So if you hit those timelines, you're good for the 1031. The other part of it is that you cannot touch the money. So when you sell your home, the money does not go to you. It goes to a 1031 exchange facilitator. This is a person, it could be an escrow company or an attorney. They hold the money until you've identified that other property, and then you close on that property. They pay the money into the purchase of the next property. So by following that timing and not touching the money, you avoid paying any capital gains taxes, which currently is 15%. You can save tens of thousands of dollars in taxes by using a 1031. And like you mentioned, and a lot of our clients even don't know about that. I'll speak with somebody out and they want to get pre-approved to buy a home. It's an investment property. I go, where's your down payment coming from? They're like, oh, we're selling this property. Oh, are you doing 1031? They're like, what's that? It's like, okay, we're going to save you about $30,000, right here, because this is how we'll set this up. And the other part of not touching the money is if you do decide to pull some money out to keep some from the 1031, you can. You don't have to put it all into the new property, but whatever you keep is called boot, and that is taxed. So whatever you keep out of the 1031, you will pay taxes on, but everything that you roll into the new property, you can defer, you can avoid, delay paying any capital gains taxes on that property.
What was mystery for me actually, how was said a like exchange. It's only a like and quote because you can sell single family and buy fourplex.
Mhm.
You can sell fourplex, buy empty land. You can sell empty land and buy commercial mall, and it's
Yes.
still gonna be a like exchange.
Yes, as long as it's investor.
I
Yes,
know, as
correct.
long as it's
That's
invested.
right.
Because
Yeah.
before I thought, okay, we have single family house, we can exchange it only to single family house, right?
Right,
Investment.
right.
But actually, you can exchange it for empty lot or video store,
Right.
for anything. So it shouldn't call alike because
Yeah,
even realtors confused,
that's true. The other question that comes up all the time is what if I buy this as an investment property, the new place, I do a 1031, but later I want to move into it as my primary residence. Maybe it's a house on a lake or something like that. You can do that. Most accountants will say you need to keep it as a rental property for at least 2 years. So if after that, then you could take that property, convert it to your principal residence, and you're not hurting your 1031 exchange.
And this is actually a huge secret how to buy house of your dream. you buy maybe small apartment, you live, accumulate enough equity to buy investment property, right? The next one you buy house is investment, putting 20% down from your first property. When you accumulate their property and you switch to bigger house, maybe house on a lake for 2 million, but you rent it out for 2 years, you don't move there yourself, so you never pay taxes. So maybe you start with 300,000 house and you jump into 2 million your dream home, but you never pay taxes selling and switching up, and when rent out maybe this house of your dream for 2 years, anyway, when you're going to renovate for yourself and move in yourself. And this is how you got from 300,000 to 2 million house, never pay any taxes. But you have to rent out your properties for 2 years. Otherwise, I know one lady, she got 800,000 penalty fee because she bought it as an investment, and like after half year move it herself there. She knew she shouldn't, but she did move in. It's a serious, it's a federal crime, 800,000 penalty fee. So make sure you rent it out for 2 years, you know.
Then you're fine.
Then you're fine.
Yeah, all CPAs will agree to that. That 2 years is sort of the general rule. Good.
Okay. So thank you, Eric, for joining me today.
Happy
a lot
to.
of new information, very valuable information.
Good.
Guys, thank you for joining us and watching our presentation. So if you have any question, please don't hesitate, right? Call us, text us, email us anytime. We will be more than happy, right?
Absolutely.
To help you.
And we're easy to find on social media or phone or email. Just reach out. Always happy to answer those financial story problems.
And help. Thank you.
Thank you.